Welcome to the Deep Dive. We're here to cut through the noise and get you informed fast. When you think about Amazon, it's just, it's this global titan, right? It seems woven into almost everything we do. Online shopping, cloud stuff, powering the internet. They are truly everywhere. But for investors, especially those looking through that disciplined value lens, think Warren Buffett, a big question pops up. How does this massive company actually stack up? Is it really a great company at a fair price? So today, we're going deep. We're digging into Amazon's financial performance over the last 10 years, 2014 right through to 2024. Our mission for you is to really get a handle on Amazon's financial health, see how it's evolved, and then put it to the test. The ultimate test, really, against those tough investment criteria championed by Warren Buffett himself. We're unpacking a pretty comprehensive investment analysis of Amazon that's ticker AMZN. It cross-validates its numbers against SEC filings, reputable databases, the works, and it focuses on the key stuff. Valuation, cash flow, balance sheet metrics.
Now, before we jump in, there's something important the source makes clear right up front. This analysis, it's based on public info. And like all financial data, it could be revised. People might interpret it differently. That's just how it is. And crucially, what we're talking about today, it's purely for educational purposes. This is not investment advice. You should always do your own homework, your own due diligence before making any investment calls. This deep dive is about understanding the data, not telling you what to buy or sell. Okay. So with that crucial context set, let's kick things off. Let's look at Amazon's pretty remarkable journey over the last decade, starting with valuation. When we look at Amazon's valuation from 2014 to 2024, the growth is, it's extraordinary, isn't it?
Oh, absolutely. Mind-boggling, really.
Market cap went from about $143 billion back in 2014 to an estimated $2.35 trillion by the end of 2024.
Yeah, that's more than a 15-fold increase. Just massive.
Reflects huge revenue growth, obviously, and just incredible investor optimism, even with some bumps along the way.
Right, that volatility is part of the story, too.
Now, the price-to-earnings ratio, the PE, that's always been pretty high historically.
Consistently high, yeah. Often way above 50, sometimes even over 100 in those earlier years. Definitely signals a rich valuation.
You even see NM not meaningful sometimes, like in 2014 and 2022. That's because earnings per share went negative those years.
Exactly. And in 2024, it landed around 39.7.
Right.
Still pretty punchy.
But the price to book, PB, that's actually trended down a bit, from over 13 times down to about 8 times in 2024.
Yeah, that's interesting. It suggests shareholder equity grew faster than the stock price itself over that period.
Okay, but here's where things get really interesting, I think. The return on equity, ROE, and return on invested capital, ROIC.
Big improvements there.
They went from negative or, low single digits back in the mid-2010s to hitting the 20-24% range between 2018 and 2021. And still strong, like 15-21% for ROE in 2023-2024.
And ROIC followed a very similar path, showing much better capital efficiency in recent years.
So what's that telling us once profitability really kicked in, especially from AWS and those other high-margin areas?
They started generating genuinely strong returns on the capital invested in the business, which is key. What's really fascinating here is how those profitability metrics, the ROE and ROIC, they only recently got to levels that you'd conventionally say justify those really premium valuations Amazon always had.
Right.
For a long, long time, the market was basically placing this huge bet on future growth, pricing in massive expectations way before the company consistently delivered those kinds of returns.
It really was a story of delayed gratification on the profitability front.
Or maybe just a different way of valuing a company with that kind of dominance and reinvestment potential.
That's a great point. So if they had those high valuations for so long without the matching profitability, how did that play out in their actual cash flow? Let's talk about the money moving in and out.
Absolutely. Well, first off, the revenue growth itself is just breathtaking. From just under $89 billion in 2014 to an estimated $638 billion by 2024.
Wow.
And crucially, their gross margins climbed significantly too, from around 29% up to nearly 49%.
So it wasn't just selling more stuff.
No, exactly. It was a big strategic shift towards those higher margin businesses like AWS you mentioned, and also their advertising business, which has just exploded. That really boosted the overall profit picture.
And that huge revenue growth, that must have translated into a massive jump in operating profit too, right?
From just $178 million in 2014 to $68.6 billion by 2024. The operating margin went from basically 0 to almost 11%.
But I noticed, looking at the numbers, net income was actually pretty volatile. There were even net losses in 2014 and 2022, although it did hit a record $59 billion in 2024. How does that square with free cash flow?
That volatility, yeah, it carries right through to free cash flow, or FCF. We saw FCF actually turn negative in 2021 and 2022, dipped by billions.
Right, I remember that.
But it wasn't necessarily a sign the business was struggling. It was more a direct result of just massive capital spending. Amazon was pouring money into building out fulfillment centers, expanding AWS infrastructure, just at an incredible rate.
Okay, so investing heavily for the future.
Exactly. But the good news, FCF bounced back strongly. Over $38 billion projected for 2024. And our source brings up owners' earnings, too. That's a Buffett measure.
Right, trying to get at the real cash earnings available to owners.
Precisely. After accounting for the spending needed just to maintain the business's competitive position. And what's interesting is even when FCF went negative those couple of years, owners' earnings were positive every single year except 2022.
Ah, okay.
In fact, owners' earnings often exceeded FCF during those heavy investment years like 2020. It suggests that even while cash was being plowed back in, the underlying earning power was still pretty solid.
Okay, so connecting the dots. Amazon's cash generation has been, let's say, lumpy, as you put it.
Yeah, lumpy is a good word.
Because they just aggressively reinvest basically every spare dollar into expansion, like a farmer constantly planting more fields, maybe.
That's a good analogy. It often leads to these temporary droughts in free cash flow while the money's going out.
Followed by surges once those investments actually start paying off.
Exactly. It's a very different cash flow pattern compared to, say, a mature company just churning out dividends, which is often what Buffett looks for.
All right, let's shift gears to stability, financial strength. Let's look at the balance sheet. Over the decade, total assets just exploded, right? $54.5 billion, up to over $620 billion.
Huge expansion.
And shareholders' equity grew even faster, thanks to keeping all those earnings in the business.
It's really quite something. And while the absolute amount of debt did go up, it peaked over $67 billion in 2022. The key thing is the debt-to-equity ratio.
What happened there?
It actually fell dramatically, from 0.77 back in 2014 down to just 0.18 in 2024.
Wow, that low.
Yeah. It's a clear sign their equity grew way faster than their borrowing, so leverage is actually quite low now.
And liquidity.
Yeah.
How are they looking on cash?
Very strong. Over $100 billion in cash and equivalents on the books in 2024.
Okay. And the current ratio? I noticed it tends to hover around 1.0. Isn't below 1 sometimes seen as a red flag?
It can be for some companies, but for Amazon, their model is different. They collect cash from customers very quickly, and they have that huge cash pile. So while it's around 1.0, maybe 1.17 in 2024, it's generally not seen as a major risk for them.
Right, context matters. What about covering the interest on their debt?
Oh, exceptionally strong there. EBIT earnings before interest and taxes covered their interest payments dozens of times over in the strong years, like 28.5 times in 2024.
So no worries about making debt payments.
Absolutely none. It really highlights that despite all the aggressive growth, Amazon's balance sheet has become incredibly robust. Low debt relative to equity, tons of cash, strong interest coverage. It gives them enormous flexibility.
That's a real strength, maybe sometimes overlooked with all the focus on growth.
Definitely.
Okay, let's wrap this section up with growth rates. What's the big picture takeaway from a decade of Amazon's growth?
I think the standout is just the sheer scale and the sustained pace of that growth. Revenue growth, exceptional. A compound annual growth rate, CAGR, of about 28% over 10 years.
That's incredible.
Yeah, annual growth was often between 20% and 38%. And even now, at their massive size, they still managed around 11% year-over-year growth in 2024.
Still double digits on that huge base.
Exactly. Net income growth, as we said, more volatile with that 2022 dip, but the long-term trend is explosive, nearly doubled from 2023 to 2024. And owners' earnings growth has also been positive long-term, despite those investment dips.
So the key takeaway?
Exceptional growth overall, especially on the top line. Revenue, and that's been absolutely critical in supporting its premium valuation over the years.
Okay, this is where it gets really interesting, I think. We've looked at the numbers, the incredible journey. Now let's put Amazon through that ultimate filter. Warren Buffett's criteria for a great company at a fair price. He wants valuation discipline, strong cash generation, consistent growth, a solid balance sheet, high profitability. So the multi-trillion-dollar question, does Amazon actually fit that mold?
Yeah, this is always the fascinating part, isn't it? Because Buffett's philosophy often looks for things that seem almost contradictory to a high-growth, constantly reinvesting tech company.
Predictability versus disruption.
Kind of, yeah. Predictability and buying assets at a discount. Let's see how Amazon stacks up point by point.
Yep.
Okay, first, valuation discipline. Buffett likes a low PE, maybe 15 or less. PB of 1.5 or less.
Amazon.
Well, it consistently fails on both counts. Its PE has never been below 15.
Yeah.
Often way higher, 50, 100 plus. Even now, around 40.
Nowhere close.
Nope. And PB, still around 8 times in 2024, much higher than 1.5.
What about margin of safety? Buying below intrinsic value.
Also debatable, leaning towards fail. Amazon just hasn't typically traded at a clear 25% discount to a conservative estimate of its value. The price has almost always baked in very optimistic future growth.
So on traditional value metrics, it's a clear mismatch.
Pretty much, yeah.
Okay, criterion 2, cash generation and allocation. Buffett wants positive free cash flow every year and FCF relative to revenue above 5%. How does Amazon do there, given the reinvestment?
This one's a partial fail. While its FCF to revenue ratio has often been above 5%, the consistency isn't there. Remember, FCF turned negative in 2021 and 2022 because of all that heavy spending.
Right. That inconsistency would be a red flag for Buffett.
Definitely. He prizes predictability. However, on return on retained earnings, where he likes to see at least 12%, and Amazon probably passes in the long run.
Because they keep everything and reinvest it effectively.
Exactly. They don't pay dividends, they retain it all, and the growth in equity and net income over time suggests a very good return on those retained earnings, especially driven by things like AWS. The long-term results of the reinvestment are impressive, even if the FCF path was bumpy.
Next up, growth and predictability. Buffett loves companies where earnings per share, EPS, are positive and just steadily rise year after year for a decade. Amazon's volatile earnings.
Yeah, that's a fail. EPS was negative in 2013 and 2022, and it dipped in other years too. It's definitely not that smooth upward line Buffett looks for.
But what about book value per share? He wants a 10-year CAGR over 10%, no annual declines.
Here Amazon passes with flying colors. Book value per share grew at an incredible 38% CAGR over the decade, and it rose every single year.
Okay, a clear pass there. But then owner's earnings positive every year, yielding at least 10% of market cap.
That's another fail. Owner's earnings dipped negative in 2022, remember? And the yield, owner's earnings divided by market cap, is usually low single digits, maybe 2% in 2024, way below Buffett's 10% benchmark.
So phenomenal growth overall, but lacking that year-to-year predictability and the high owner earnings yield he likes.
That sums it up well.
All right, criterion 4, balance sheet safety. This seems like an area where Amazon has really shored things up over the decade.
It really has. First test, debt to equity below 0.5. Pass. Comfortably below, around 0.18 now.
Good. Interest coverage of 3 times or more.
Another clear pass. Coverage is very strong, 28.5 times in 2024. No issues there.
Interest expense less than 15% of operating income.
Also a pass. Generally well under that, though 2022 is a bit of an outlier.
Okay, but what about the current ratio? He likes to see it above 1.5. Amazon's around 1.0.
Right. So technically that's a fail on his strict criteria. Even though, as we discussed, Amazon's cash pile and business model mitigate the risk, it doesn't meet that specific 1.5 buffer.
So mostly strong on the balance sheet, but a technical miss on the current ratio.
Exactly. Rock solid on debt and interest, just a quirk on that liquidity ratio compared to his rule.
And finally, criterion 5, profitability and efficiency. Has Amazon finally reached the kind of consistent high profitability metrics Buffett looks for?
It's a mixed bag here still. Gross margin of 40% or higher, pass, but only recently. It was below 40% until 2018. Now it's climbed up near 49% thanks to AWS and ads.
Okay, net profit margin 20% or higher.
That's a clear fail, never even close to 20%. The highest was around 9.3% in 2024. Amazon's model is built on volume and scale, not super thick net margins.
Right. What about return on equity, ROE, and return on invested capital, ROIC? He likes 15% or more on average over 10 years.
These are kind of marginal passes, maybe? Recent years have been strong, often above 15%, but the 10-year average is pulled down by the weaker results earlier on, so it's borderline.
Okay, and depreciation relative to gross profit, less than 10%.
That's a definite fail. It's consistently been in the mid-teens. This points to how asset-intensive parts of Amazon's business are, which is something Buffett typically doesn't favor. He prefers asset-light businesses.
So summing up profitability, improvements, especially in gross margin and recent returns, but still falls short on net margin consistency and capital efficiency judged by that depreciation metric.
Precisely. Mixed results against his profitability benchmarks.
Okay, so we've run Amazon through Buffett's checklist. It's clear it doesn't tick every box, maybe not even most, for a traditional value investor following his rules strictly. But what about its actual intrinsic value? Our source also looked at this using a discounted cash flow analysis, DCF. trying to estimate what the company is really worth based on projected future cash flows.
Right, and the DCF always brings up that critical question. What growth rate do you assume for future free cash flow? Because the output is hugely sensitive to that input. This analysis used Amazon's 2024 FCF of about $38 billion as the starting point, a standard 10% discount rate, and a 3% long-term growth rate after the initial 10 years.
So what do the different scenarios show? Let's start conservative.
Okay, the conservative case used Amazon's lowest positive historical FCF growth rate, which was 20% annually. Plugging that in, the intrinsic value came out around $1.98 trillion. That's about $185 per share.
And the implication, with the stock trading around, say, $234.
The implication is pretty stark. This conservative DCF suggests Amazon is actually overvalued right now, offering no margin of safety for an investor demanding one.
Wow, okay, that's a strong perspective. But what if we assume growth closer to its historical average, more of a middle ground?
That's the nominal case. This one assumes 35% FCF growth annually for 10 years.
Which is still very high.
Very aggressive, yes, especially for a company this size sustaining it for a decade.
Yeah.
But if you assume that, the intrinsic value jumps dramatically to about $5.75 trillion or roughly $538 per share.
Okay, so if they can sustain that kind of growth, the current price looks potentially undervalued. Big if, though.
Huge if. It highlights how much belief in continued high growth is needed to justify the current valuation, let alone see upside. And just to show the extreme sensitivity, there's an optimistic case. This assumes 50% FCF growth annually.
Which seems wildly optimistic.
It's definitely bullish, though maybe not totally out of the realm of possibility given some past spikes. But plugging that in gives you a valuation of roughly $15.5 trillion or $450 per share.
Okay, that seems more like a theoretical upper limit.
Exactly. It mainly serves to illustrate just how massively the valuation swings based on that growth assumption.
So boiling down these different DCF models, what's the practical takeaway?
The key takeaway is just how extremely sensitive Amazon's valuation is to your assumptions about its future growth. You really only get an intrinsic value comfortably above the current stock price with a decent margin of safety if you plug in very robust growth numbers, think 30% plus, sustained for a decade.
Which is a big ask.
It's a very big ask. So a value investor demanding that classic 25% margin of safety, like Buffett often does, would likely only find today's price justifiable under those highly optimistic scenarios. It really underscores the significant growth expectations already baked into the share price.
Okay, let's try and pull this all together.
Yeah.
Amazon is, well, it's undeniably unique, isn't it?
Yeah.
Transformed from just selling books online to this diversified tech behemoth. It shows absolutely extraordinary growth, scaling cash flows dramatically, especially lately, and it's built a really strong balance sheet, established powerful competitive advantages with AWS, e-commerce, advertising.
No question, it's a powerhouse. And if we circle back to Buffett's great company at a fair price idea, Amazon certainly looks like a great company by many measures. Innovation, strong moats, and now as it matures, showing those high returns on capital. But it historically lacked that stable, predictable earnings stream, and crucially, the low price entry point that Buffett's framework really favors. It always traded at high valuations, profitability was thin for a long time. Only recently have the earnings quality and margins started looking more like something Buffett might typically like.
But by then, the price already reflected a lot of that, right?
Exactly. Which fundamentally makes Amazon more of a growth investment case rather than a classic value play in the traditional Buffett sense. And our source highlights the potential rewards and, of course, the risks. The rewards are tied to continued dominance in cloud with AWS and advertising, e-commerce, maybe new ventures like AI or healthcare. If those engines keep firing, the day's price might look perfectly reasonable down the road.
But the risks are real, too.
Oh, yeah. Margin pressure, rising costs, maybe unionization, significant regulatory heat, especially antitrust concerns, fierce competition, particularly from Microsoft and Google in the cloud, and just the basic law of large numbers. A company this big simply cannot keep growing at 30% plus forever. Growth has to slow eventually.
So wrapping up, what does this all mean for you, the listener? I think this deep dive really shows how Amazon challenges those traditional value investing principles. It's a fascinating case study. It shows how immense scale and hypergrowth, even with bumps in profitability along the way, can create enormous value. It's kind of a paradox that even Buffett himself seems to have acknowledged or grappled with in recent years by actually investing in it, albeit perhaps through his lieutenants initially.
Yeah, the insight might not be just whether Amazon fits the old rules, but whether those rules fully capture the value in today's tech giants.
Think about Buffett's famous line, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Amazon, arguably a wonderful company. The key question for your investment approach is whether today's price will ultimately prove to have been fair.
A dyed-in-the-wool value investor, looking for that big margin of safety, might still wait for a significant pullback, maybe a market correction.
While a growth-oriented investor might see the quality, the potential, the moats, and be willing to pay the current price, betting on that future expansion and innovation continuing. Different strokes for different folks. And just one final reminder, all the analysis we discussed today is based on publicly available sources and might be subject to revisions, different interpretations. This content is strictly for educational purposes. It is absolutely not investment advice. Please, always conduct your own thorough due diligence. Maybe talk to a qualified financial advisor before making any investment decisions. Thanks for joining us on the Deep Dive.